This episode of From Angel to Exit is brought to you by Align 5. Align 5 specializes in mergers and acquisitions for growth-focused entrepreneurs and family businesses. With decades of buy and sell side experience, they prioritize client alignment, avoiding conflicts of interest common in other firms. Align 5 delivers above average industry results by customizing strategies for diverse industries, ensuring optimal valuations and securing strategic acquisitions or exit partners. If you want to find out more, check out align5.com. That's align, the number 5.com. Are you serious about planning a successful business exit? From Angel to Exit is your go-to resource. Subscribe to our newsletter at eckfeldt.com/podcast for even more valuable insights. And to get personalized guidance, take our free exit readiness assessment. It's just 24 questions, and it will give you a clear picture of your exit readiness. Find the assessment at eckfeldt.com/exit. Submit your results, and we'll schedule a free follow-up call to discuss your specific situation and the best way to maximize your valuation and ensure a successful transaction. Now, back to the episode. Welcome, everyone. This is From Angel to Exit. I'm Bruce Eckfeldt. I'm your host. Our guest today is Karl Sigerist. He is Managing Director at the Shaughnessy Group. We're going to talk to him about really the M&A market and kind of his experience in working with companies in the sale process, what he's seen, kind of the trends, mistakes, things that people have made that make it either easier or harder to go through this process. Karl's a lot of experience. I'm really excited for this and kind of hearing from the, kind of the other side of the coin, like people that help this process work with founders, kind of what they've seen and what they've noticed. With all that, Karl, welcome to the program.
Thank you, Bruce. Thanks for having me.
Yeah, it's a pleasure. Yeah. Before we kind of dive into everything that's going on, kind of in the M&A market and kind of what you've been doing with businesses and the sale process, let's get a little background. How did you get into this work? What was your professional history? Give us a little backstory.
Absolutely. So I started out as the child of entrepreneurs, which made me at an early age learn a lot at the kitchen table that a friend of mine said, well, you can't learn that at university. So, mom and dad's highs and lows as entrepreneurs, and then ultimately having had success and failure at numerous different businesses and different sectors, I swore it off. I said, that's not the life for me. I'm going to get a nice corporate job and drive a vanilla car, live in a vanilla house, and have that steady experience. I worked for the first 10 years of my life in technology space, and back in my day, technology was predominantly hardware. Today, technology, software. I know. And then at that time, because technology was hardware was expensive, people needed to finance that hardware. That exposed me to how you help clients finance that equipment, became very intrigued with the whole financial service space, and then transitioned out of hardware and distribution, ultimately to financial services, putting together all sorts of finance programs for manufacturers and OEMs, and ultimately all these types of programs were helping entrepreneurs finance the growth of their business at a time when these types of forms of financing, we're talking 80s, 90s, were just not something that your typical banks did. I grew to ever more responsible roles in these companies, ultimately leading them as chief operating officer, president, CEO, managing director roles in Canada and also in Europe, and then back in Canada. And so when we exited our third business, having grown many of these from kind of guys at around the dining room table to real businesses with a couple of hundred employees. We and some of these businesses we grew even on the technology side through acquisition. Some we grew organically. We did a mix of these things. And having, as my wife said, been a failed retiree a number of times over, being a self-confessed deal junkie, I thought, well, what am I going to do next? And I thought, those same entrepreneurs that we helped grow their businesses with commercial and corporate finance, most likely are going to have the similar challenges come time to exit. And the thesis was that you have, I would say, really large businesses that the investment bankers will line up to win the mandate to sell them.
Yeah.
You have really small businesses that are very well served by commercial realtor slash business brokers. And you've got this group in the middle, what we coined a lower middle market in Canada of companies with more than a million, typically less than $5 million in EBITDA. Their
Hmm.
businesses are too small to get the attention of the investment banks and yet too sophisticated for a broker listing. They
Yeah.
need a fully robust, broad auction process, uh, attracting strategic and financial buyers. And that's really what the Shaughnessy Group does, leveraging myself and my colleagues. We've worked together in previous iterations of other businesses, helping initially the thesis was help baby boomers sell their businesses.
Yeah.
With less than 40% of baby boomers today still owning businesses, we're now working with next generation entrepreneurs. So really, if you're born before the 80s and you have a lower middle market business to sell, we work with you. Likewise, if you're a new entrepreneur and you're looking to acquire, whether it's the entrepreneur through acquisition model or the smaller micro private equity funds that are just have done their first or second deal. We work sort of helping them acquire. Given our focus in Canada, we also help foreign-based private equity and family offices
Hmm.
that want to allocate to Canada or strategics that are looking to enter the market on the buy side. But 80% of our revenue does sell side, and about 20% of our work is and revenue comes from buy side.
Yeah.
And that's sort of where we're at. So, yeah.
I want to kind of go back to your experience you had in kind of scaling your companies, and you mentioned the kind of organic versus inorganic growth acquisition. I guess what fueled that process for you? Like when did you decide to focus on organic growth? When did you decide to look at acquisitions for growth? Was there any kind of rubrics there that you used to help guide that process?
Um, so the businesses that we grew organically, we had a very, very strong competitive technological moat. We were
Okay.
first movers
Yeah.
doing things that none of our rivals did, and we were effectively able to scale because we were just technologically so much farther ahead. Like, you're think about it like you're selling a shovel and a guy shows up with a bulldozer. Like
Yeah.
the technological difference was just so severe. It was just there was no point in buying shovel companies
Yeah.
or guys that had shovels when the bulldozer showed up. So
Yeah.
that's really where those tech businesses, when we were on the acquisition side, that came with really were geographically somewhat constrained in the earlier part of my career. A lot of these were technology hardware distribution companies, or they were established, they were profitable, and the owners were looking for exits. You weren't going to disrupt the industry as
Yeah.
much, so it made more sense to grow through acquisition. The public
Yeah.
company that I worked for, that was really their whole thesis is acquiring and consolidating and doing a roll up of a sector. They were doing it globally, and we were responsible for doing it in Canada.
Got it. Got it.
Yeah.
And anything that you looked for in these acquisitions, I guess, what did you prioritize, or how did you kind of filter deals, evaluate deals, decide which ones you were going to go with? Like what was important for you on the acquisition side?
So I think every acquirer has got a different thesis.
Yeah.
In this case, this was a real estate grab.
Okay.
And this in the industry I was in, there were two different players. One was buying the absolute best company each industry and consolidating it. The other one was buying uh, the not best companies in the
Hmm.
industry and was consolidating them. So in the one strategy, I'd worked the opportunity to work for both companies. The one was buy it and leave it alone. Management's in
Hmm.
place. The business is running well. The other was take it over and transform it with a lot of direction from the center because things weren't ideal or weren't perfect at those companies.
Yeah.
So different strategies at different times. Most of the clients we work with today,
Yeah.
when we're working on buy side, it's you're depending on, again, if you're looking to acquire a business to install yourself as a CEO versus if you're looking to invest in the growth of a business and you want to back a new management team. So different criteria, different thesis, different investment strategies, and really it's important to have that upfront strategic conversation with our clients today. Who are you? What are you trying to do? What are your strengths? What are your weaknesses? Because ultimately, it just changes who you approach and what you approach them with.
Yeah, and I'm sure how you approach it. I mean, if you're looking at a distressed asset, right, or a distressed situation, right, you're going to be asking very different questions or looking for insights around the company very differently. You mentioned this idea of micro private equity. I wanted to kind of understand what that was. What is this category?
So I would say that what we're seeing now is typically what we're starting to see is we have entrepreneurs who started out with the sort of similar to the entrepreneur through acquisition model.
Okay.
They've got one under the belt, and they're acquiring a second and a third. Often, some cases, separate platforms. Or what I also see is these are, I think next generation private equity funds. Family offices, institutional investors have become much more. The days of getting a blank check and $100 million to go and invest are those aren't here. But what will happen is, the investors will say, Karl and Bruce, we like your idea. We want to back you. Go bring us the first deal. And we go do the first deal. They say, that was great. We do another deal. And one day we look back and we say, hey, we've got 9 different companies that we now are running with 9 separate special purpose vehicles. We're effectively the GPs of 9 different funds, but all backed by investors. And maybe at that point, when you then go back to your high net worth or your family offices, or if you go back to your institutional, say, here's our track record. And then it becomes more an effective thing. Okay, you're looking to raise $500 million for your next round. You guys now have track records. You now have experience. You've had some exits, and it's so I see micro private equity is typically these. They do their transactions through one deal at a time and grow themselves into the typical asset manager.
It's like an adolescent private equity kind of.
Yeah. Very much.
I guess how do you organize the private equity world in any way? Like people use this term fairly loosely, and I find that there's a lot of nuance in terms of the type of people that kind of participate in a financial kind of private equity type of deal. I guess how do you define a private equity deal, and then how do you look at the private equity world in terms of types of players?
So you've in our space, of course, we're not playing with the largest private equity funds at all. Our clients are typically either a smaller private equity fund that considers a $3 million EBITDA business a platform investment. Okay. For larger private equity, these at best would be add-ons to existing platforms that they have. So in that case, you're really marketing to a strategic who is private equity backed. And so now you may be coming in to talk to the CEO that has a platform that wants to add on a business in Canada. But we may also have contacts with the same, knowing that the CEO and the private equity fund have a vested mutual interest in talking to both parties. Sometimes you come in through the CEO, depending on the fund. Other times you come in through the private equity. It depends on the nature of how they operate. Some CEOs do a great job running the business, but are very strong in operations. Have got many skills, but they leave the add-on acquisitions to the private equity fund, and others. Once they get to a certain size, they may even have in-house, corporate development team. So again, each customer's there's no. And we play on the small end of this, right? So
So this kind of category, I think you mentioned $1 to $5 million. Like how did you really narrow that down or niche that down? I mean, those are very specific numbers, and I understand the kind of up above and below, but
so part of the thesis here was that where are you going to get your deal flow from? So I was fortunate in having spent decades in Canada. I've got an extremely large, I used the word Rolodex. Today you would say LinkedIn network, for the people who don't know what a Rolodex is.
Oh
And
boy.
so I just went out to them and said, this is what we're thinking of doing. And the conversations we had with the Price Waterhouses, the KPMGs, the Ernst and Youngs, the big four accounting firms, our contacts there said, well, that's a great idea because we have clients that we do audit work for. We have clients we do tax work for. We have clients we do all sorts of work for. But when we send them over to our deal teams, the deal's too small.
Yeah.
Likewise, in Canada, where the banking, wealth management, investment banking is highly consolidated. Really, there's five major players.
Yeah.
You may have your wealth management with, Toronto Dominion Bank. You may have your company's corporate credit with either the same bank or with another one. So you're talking to your wealth manager saying it's time to transition the family business. They refer you over to the investment bank, and the investment bank goes on we don't play south of sort of $50 million enterprise
Yeah.
value transactions. So all of these contacts of ours said we need someone that we can refer to who isn't also going to try to take over the wealth management after
Yeah.
the transaction or steal the accounting work or what have you. So
Yeah.
we stick to our lane and help the family realize the value, protect their legacy of the business, and our referral network continues to manage their wealth.
Yeah.
The accounting
You're a
firms
safe
continue.
partner.
Yeah.
Yeah.
And we just
Yeah.
stick to that line. And again, if they've had those, you see this often, shops like us, people start this way and then have ambitions and start doing bigger deals. And that's great. Depends on what you're trying to do. But as
Yeah.
soon as you start doing that, you know, you're starting to go into territory that that is well served
Yeah.
by
It's
your
kind of below your markets.
referral network. And, you can,
Yeah.
my whole career, it's just like I say what I do and I do what I say.
Yeah.
And I just, that's how you build a reputation.
Yeah. Focus on your
Yeah.
niche. So when you're talking about some of these companies, so say you get a introduction, a referral, and you're talking with a founder, CEO, like where do you start? I guess what's the initial part of the conversation that you need to kind of understand, and then where do you go from there in terms of figuring out where someone is and how ready they are and their time frame and those questions?
So typically one of the first things we do is we talk about confidentiality. And that is we need to put an NDA in place between us, recognizing that everything needs to be confidential. And it needs to be confidential because the stakeholders in your business, often you may be exploring this. You may not actually be executing on this. So your employees, your suppliers, your customers, the less people who initially know about this, the more critical to your business, your rivals, what have you. So confidentiality is an absolute must. Once we put a confidentiality agreement in place between our team and the people exploring this, we start with something real simple. Last couple of years financial statements, and at that point we can assess their statements to see what in Canada are they statement. You have different degrees of assurance. So if you're a business that's never borrowed any money and you have no outside investors, you can get away with in Canada what we refer to as compilation quality assurance, which is really the statements are for the owners of the business. Maybe of course they've got tax returns. But if you start to borrow, if you're borrowing money from a bank in Canada, you're going to be at review engagement. So the level of assurance moves up. It also means that the statements have been vetted to a level of assurance. They're GAAP compliant. And then also, if you get larger, you most likely have audited statements. So the quality of the preparation, the first thing we look at is really how strong is the management's ability to report the results of the business historically, and what level of assurance have we got there? Nothing worse if you think about all the reasons why deals fail in the future, and often after LOI is executed, is the lack of preparation. So we kind of look at this as investors ourselves and go, would we invest in this business? What would we need to know? Can the organization that wants to be sold bring this information completely, thoroughly, professionally, share it with us? And how quickly can they do that? Like if everything you ask for, they don't have.
It takes them 6 weeks to turn
Yeah,
around.
right. Yeah, you
Yeah.
already know, like, that there's work to be done here
Yeah.
in preparation. There's 80% of lower middle market transactions fail.
Hmm.
Uh,
And like why? Like what's your how do you break those numbers down?
I would say in the highest level, it would simply be to say preparation,
Yeah.
lack of preparation on uh, management for the process, lack of coaching and mentoring as to what will likely be expected of
Yeah.
those people through this process. You hire an intermediary to help you through the process because you should be focused on running your business. You
Exactly.
cannot do this part time. You cannot do this off the side of your desk. You have to realize that the people buying your business buy businesses for a living,
Yeah.
and you're trying to do this part time. Like
Yeah.
you're showing up to the party ill prepared. So always bring in, I think, professional advisors to help you through this process while you continue to operate your business. Your business will be under so much more scrutiny than it's ever been as parties start to look at your business,
Yeah.
and you need to be comfortable and ready for this scrutiny ahead of time, right? So reasons why they fail, to your question: overvaluation, lack of preparation. I touched on
Mm-hmm.
that. The business isn't transferable.
Yeah.
Uh,
Not
it's
viable.
it's the Genghis Khan model. Genghis Khan was a great ruler, ruled a vast empire, but the moment he passed away, the whole empire collapsed.
Yeah.
All right,
I
so
may use this one.
yeah, that's just the way I think about it. And then there is no succession plan.
Yeah.
So, Genghis Khan did not have a succession plan.
Yeah.
He was still a fierce and successful,
Oh yeah.
history
I'm not sure you
remembers him
want him gone.
fondly. But you don't want to fail, right? You've built your little empire. You've
Yeah.
built your business. It needs to be transferable.
Yeah.
Have you, business transition is ownership change, but leadership succession needs to happen once you get to a certain size and place in your business. Um, you know, uh, you hear it from time to time where business associates uh, suddenly pass away over the weekend.
Yeah.
That business is just left with no leadership succession.
Yeah. They
The
cut it.
family is left in the lurch. The employees are left in the lurch. The customers. So whether you're selling or not, you need to have a succession plan, particularly as if your business starts to scale. So those are kind of the five main reasons that they fail. Overvaluation is the first thing after we get your financial statements.
Okay.
We work and we do evaluation of your business, and we typically do that work complementary
Okay.
because we want to be able to dig deep and come back to you and say, Bruce, your business is worth 34 million. And
Yeah.
Bruce is going to go, well, I think it's worth 80 million. Um, here's the information.
Mm-hmm.
Here's the data. Here are the comps. Here's the cash flow. Here's what another investor is going to come up with. And if you can align with us on this work
Yeah.
and this valuation, then you're you're going to be, you're going to have a hard time with whatever happens next in the process. Your intermediary M&A advisor can run an amazing process, bring multiple parties to the table, but
Yeah.
the gap isn't there. In our case, we work almost predominantly on a success fee basis.
Yeah.
So what that means is we'll invest something like 2,000 man hours from our team, help sell a company.
Yeah.
Last thing we want to do is get at the end of that process and have a massive gap in what the market believes your business is worth, what
Yeah.
different methodologies tell you what your business is worth, what the market is saying your business is worth. And so, we can't afford to engage with clients that we have this massive sense of valuation. And a lot of
Set up
folks
for
have never
success.
done a professional valuation. It's typically an expensive and time-consuming ordeal. So we typically do that work. We're former entrepreneurs. We want to have
Yeah.
skin. We want to have skin in the game when we come to sell
Yep.
your business. We need to find out that we're really culturally. We also need to be culturally aligned with our clients. It's because this is an emotive process. You're going to be working together for 3 months,
Mm-hmm.
2 years. COVID happens. an hour together for 3 years.
Yeah.
Uh, uh, your business gets hit by, some geopolitical event. The deals pause, the
Yeah.
timelines extend. So we're together often uh, we become, as one
Yeah.
seller said to me, you're the brother from another mother, because we've been working together so long.
Yeah.
He had a fantastic exit. That's probably why I got.
Probably helped you.
That's probably why he called me that.
um, so I want to talk about two things. One is I want to get back to the cultural thing, but the valuation stuff. So when you first look at a business and are coming up with these initial valuations, I guess what are the models you're using, or what's your kind of general approach in terms of, given the type of business and the type of exit they're considering, how do you, what's your strategies, or what tools do you use, or what processes do you use for coming up with valuations?
So it's two ways, right? Are you selling assets or are you selling shares? That's the first question. Let's assume we're going to be selling shares, so we're selling the company. Mm-hmm. Assets are a whole different, typically. So now we need to look at the industry and the sector. If you think about what historically has been happening in technology space, companies are being valued as on revenue, a multiple of revenue, and the 40 rule. Both you had to have a certain growth rate, a certain margin rate. So different industries are valued differently. For most, I would say, traditional businesses, like if you founded your business 20, 30, 10, 20, 30 years ago, and you've got a nice growing, reasonable growth, but not a rocket ship growth rate. You're going to have gross margins. You're going to have an EBITDA or a profit, at your business. There's a couple of obviously one thing is the future of the future cash flow of your business is the only thing that the buyer has to pay to get a return on the present value they're giving you today. So the future value has a lot to do. The future, the growth, and the cash flow that comes off of that. So a discounted cash flow model helps you to help you with that. Is there other assets or intellectual property that the business has that might be worth more outside of the business? So you've got to, do some analysis on that. And then there's comparable transactions, right? So if my buggy whip company with $1 million of EBITDA sold for $4 million, 4 times EBITDA, it's not likely that a similar company will sell for slightly more, slightly less. What causes it to go slightly more, slightly less is quality, right? So is your growth slightly better than your peers? Are your gross margins slightly better or worse than your peers? Is your SG&A better or worse than your peers? And is your ultimate EBITDA margin better or worse than your peers? If you're beating your peers in all these things, you're a much higher quality company. You'll probably get at the higher end of the comparable or multiple range for your business. And if you're below, our process points that out. And if you, again, that also is a benefit, because now you can say, well, Karl, your business has got, a good growth rate, but you got slightly lower margins. Karl can start to work on that. So, but that when they finally do go to market with this business, the company's already started to make moves to improve itself. We've in that regard.
How do you navigate that? Because I think that's an interesting one where you come up, you get an introduction, you start looking at a company and say they're, $3 million, but there's some hair on it. There's they could be doing some better things, right? There's something, and also it's like, okay, your multiples at 3, are going to be maybe 3 times, but if you could get to 10, right now you might be a standard of 4 or 5 times just because of size. Like, how do you advise owners around look, if we were going to sell in the next 6, 12 months, you're probably looking at this, but if you focus on these things and in the next 2 or 3 years hit these numbers or grow a little bit, we could be talking a really different game. Like, what's the process for you in terms of helping them sort through that?
So a lot of that, what we do is education. So, and you just touched on something. A company with less than $1 million in EBITDA is going to have a much lower multiple of EBITDA, where as soon as you get north of $1 million, and then of $2 million, of $3 million, of $4 million, the sheer amount of EBITDA dollars increases, but the multiple also increases.
Yeah.
So, this is one of the plays is typically companies under $1 million of EBITDA are going to have a 3 multiple, 3.5 multiple. You start getting 2 or $3 million, now you're getting into the 7, 7.5, 8 multiple because just the sheer amount. Now, why is that? Because a company that's making $2 or $3 million of EBITDA, there's a bunch of things that have happened in the history of that company. It's likely larger, its systems are more robust, its management team is in place. There's a whole, but you don't, the same 5 people that make $1 million or the 50 people that make $1 million of EBITDA, when they start making $3 million of EBITDA, are not the same 50 people.
Yeah.
Like they're just, maybe it's 65 or 75 people. They're more efficient, they're more effective, and the way they run the business is just better in every qualitative measure. And that's how you get your multiple to grow up. So it's raw dollars, but the raw dollars ultimately are the result of the quality of the team that produces that.
Yeah, I always joke it's the inverse of why insurance premiums for males at age 40 are much lower than males at age 21. Like we've gone through all the risk, all the things that can happen probably have happened already.
Yeah,
so
it's not likely a 40-year-old's getting 2 speeding tickets on a weekend than a 16-year-old that I know did.
Yeah. Let's talk about making the market, because I think that's a really interesting part, and I think the core of what you end up doing for these companies is how do you go from, hey, you've got a really interesting company, there's some opportunity here, you've got future cash flows, like we've got underlying assets and capabilities that could be really valuable to people. Like, how do you start like looking at, okay, this is probably the path, or this is where we're looking, and we're probably looking at doing a financial, or we think there's some strategic opportunities. Like, what's the process for figuring out the market, and then how do you start to make that for an actual transaction?
So a lot of that is too. There's always this, who's the strategic audience for your business, strategic acquirers, and then who are the financial buyers for who either already own strategics in your space, which is kind of a doubling up on the same strategic, coming at them both at the CEO of the strategic and at the private equity who owns the strategic, and or public strategics that are known to acquire businesses in this space. And then there is the this whole private equity or financial buyer world, which is both private equity and family offices. Having been doing this now for coming up on 8 years in November, we've built a very large proprietary database of not just strategic acquirers, financial acquirers, financials, both family and private equity acquirers, we are regularly in communication with around what their thesis of investment are, what have they acquired, what are they looking for. So typically we will go out with we will work with and develop a strategic list with our client that we will reach out to on behalf of our client. But we have this massive network of financial buyers, family offices, private equity, their law firms, their accounting firms, and all the other advisors in the community who have their eyes open for their clients in turn. So it's a very broad. Typically, obviously we're looking for companies that have broad appeal in that way. So it's a very, very, very it's a very big undertaking. The preparation of the company, the preparation of the marketing materials, the preparation of the quality of earnings that we typically have our clients do. So sell side quality of earnings work. You do that again, it coaches and mentors the sellers for deep due diligence by producing a sell side quality of earnings. We produce the SIM, we produce the teaser, we produce the target list, we start our outreach. By this time, our clients have been heavily coached and mentored by our team on all the questions that they could. Now, there's not too many questions that come up once we get in market that they haven't either been asked by our team, haven't been asked by the quality of earnings folks or others that the lawyers, the M&A lawyers that are all part of this process. So it's a massive undertaking.
Yeah. Yeah. And timeframes. I mean, what do you generally advise, or what do you generally tell folks?
We say we can take up to 2 years. Again, it depends on how prepared you are,
Yeah.
right? Uh, you know, uh, I had a business that we were selling. We set up the data room. We had the audited statements. We had everything already set up before we even engaged the investment banker. Most people are not that uh, proactive.
Hmm.
They, and don't really need to be. Part of your role as the investment banker or the M&A advisor is to help coordinate this whole project.
Hmm.
But most of it's preparation. If your year end is, if you engage with, 6 months after your year end, like of your business, and
Yep.
or you work with your quality of earnings firm, you take too long to get them the information. All of that, just the preparation phase is typically what I find. It can go real quick. We can, if you give us everything you need, we can have your sim ready in less than 5 weeks.
Hmm.
Uh, but it's all dependent on how quickly we can get access to the information around your
Yeah.
company, your systems. So financial systems, HR systems, sales and marketing, CRMs, marketing information, operational information, ERP information. If that all is very quickly forthcoming, we can be in market real fast. Uh,
Yeah.
Unfortunately, it just typically isn't. It's
Typically
just
not.
because again, all these people aren't uh, dedicated wholly to
Yeah.
our preparation process. They need to continue to run their business.
Yeah.
So we kind of plan for, I think you can easily, it's probably under 2 years.
Hmm.
And then uh, even the best laid plans, you get a war in Ukraine, you get
Yeah.
a regime change in the United States, other countries, depending on,
Hmm.
all these, life happens, COVID, seems to be every couple of years. One of
Yeah.
the,
Some
we
curveball.
as our team's gone through a number of these different events, newsworthy events, right? So whether in
Hmm.
the 80s the market crashed, or
Yeah.
in the 90s, today there's a whole lot of talk about tariffs and free trade, or the lack of free trade.
Yeah. Exactly.
Uh, or, I know some of us are old enough to remember pre-1994 when
Uh-huh.
tariffs were just a normal course of doing business,
Yeah.
right? So when post-COVID, there was this supply chain risk, meaning you may have had diversified suppliers, but what you didn't do is do the analysis, say, yes, they were different suppliers, but they were from the same country.
Yeah. Exactly. Yeah.
Today, with tariffs, it's similar. Customer concentration. Yes, I
Hmm.
don't have any one customer that's more than 10% of my revenue, but they're all in the same country.
Yeah.
So
Exactly.
that
80%
that
of
was
my.
just another layer
Yeah.
of analysis that wasn't there previously.
Yeah.
So it
Yeah.
you know
What I kind of wanted to finish with, just like two or three things that you'd advise early stage, founder CEOs, whether it's, when they kind of first start their company or early stages of the company, that they kind of do, or they invest in, or they kind of choose, in terms of how they're organizing themselves, how they're organizing their business, that's going to help them, serve them well later when they start to get into this process that, it's harder to do later. If you get this right sooner, it's going to make your life a lot easier. What would you advise them?
so for about 20 years I was a seed or angel investor.
Hmm.
And I worked with a lot of startup CEOs, and a lot of what I shared was things that people in my day shared with me. One of the first things that someone shared with me is, when you get on an airplane, what's the first thing you check? And I, of course, said all kinds of things. He goes, check where the exits are. And I said, okay, how does that relate to business? Well, ultimately, every business will have an exit.
Yeah.
So um, when I worked with startup CEOs, a lot of times my initial work with them was around valuation. Uh,
Okay.
what 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 is your business worth, and why is it worth that? And what are the metrics to drive valuation in your business? And what activities are you doing that have nothing to do with future value of your business? So let's stop doing those, and let's focus on the things that create value. And if you, as a startup founder, and your board or your advisors or your investors, you need to be aligned on valuation, even at the early stage, right?
Hmm.
So if you're dealing with, product market fit, those are three succinct different things. Many founders think those are two things. Those are three things. If you can't get clarity around that, right? Engineering founder, amazing product. There's people that aren't buying my product, so there's a market. Have you got fit? Do you have traction? Traction isn't just eyeballs. Traction is healthy tension in the market where people are trading their money for what you are selling. That has to happen. Then you've got those. Now you're starting to create value. And that's typically what I look at with all businesses is you can get very busy doing things, fill your day with busy work. Where is this tied to strategically creating value in my business? It's a common in the angel world, in the investor world. Is this a business being built or for great growth? Or is this a business being built as what we call a lifestyle business?
Yeah.
This business is going to give you and your family an amazing lifestyle. It's very difficult to find investors support you.
Yeah.
It will also be extremely difficult when it comes time to sell that business because most financial buyers aren't looking for lifestyle businesses. They're looking for businesses they can acquire and scale and have a management team in place that can go forward. Smaller entrepreneur. No, there is that whole entrepreneur through acquisition community. They're exactly trying to solve that problem. For those businesses that were lifestyle businesses but could become more scalable and more transferable, the entrepreneur through acquisition is really where that entrepreneur takes the risk, takes on the business, probably calls out all the cousins and family members and memberships and stuff that aren't really part of the business, and then is able to scale the business. So.
Yeah. No, it's good advice. I think that's a lot of this is thinking like a buyer ultimately, right? Like if you're just thinking like an owner the whole time, you'll never really kind of get out of that box.
I say this to entrepreneurs. I say, listen, you figured out a niche. You figured out what customers needed. You were able to completely be in the shoes of the customer and figure out something that they wanted that no one had figured out, and you're selling it to them. Now, when it comes to selling your business, you need to behave the same way. The buyer is your customer. And you need to be able to understand it from the buyer's perspective. And you'll get there much faster. You will not find, you get this sometimes with sellers that find that every question about their business is take it personally.
Yeah, exactly. Personal affront.
Right? It's a personal affront versus, it's no different if you're whatever project or service you're providing. People are going to have critical questions to better understand the value that comes from your product or service. No different when it comes to selling your business. When people are asking you critical questions, they're telling you they are interested. They are not objecting.
It's a good sign.
Right? It's a good sign if from a sales perspective.
Yeah. Karl, this has been a pleasure. If people want to find out more about you, get more information, what's the best way to get that?
Probably, I would say look me up on LinkedIn, connect there. You can also follow our company on LinkedIn. Our company is Shaughnessy.group. If you want to go to the website, we have learned that publishing a tremendous amount of content, like what we talked about, and education is the first. Learning and education is a start. And talk to us early. I'm talking 10 years ahead of time, 7 years ahead of time, 5 years ahead of time, so that a lot of these things take time to implement. Some of this is businesses that are aspirational, and the more informed you become, ultimately, even if you never engage with us, your business will just do better because of it. So thanks again, Bruce.
I always joke that the best time to start thinking about an exit is when you found the business. The second best time is now.
Yeah. Yes, totally.
Karl, thank you so much. I appreciate the time.
Take care. Thank you.